Good afternoon, everyone. Gabe Velazquez here with you, transparenttrading Hope everybody had a great week. Um, Welcome, everybody, to the channel. All right, let's get into it. So, yeah, we had quite a week. We had a fantastic week. I have to say, again, not all trades work out and all that, but here at TTS, we had a fantastic week. We as I mentioned on Tuesday, we were in not DocuSign, CrowdStrike, which I don't know if you guys were watching that. We were in front of the Fed, in front of Chairman Powell's announcement. That worked out beautifully. Best Buy and so on and so forth. So all in all, we had a pretty good week. We did take a really small loss on the yen last night. Just kind of reviewing some of the positions. Now next week, let's get into talking about next week. It's kind of going to be a little bit of a vacuum in terms of it's quiet period for Fed speakers, and the only data we have really with the non-farm. Hey, how you doing, JT? Good to see you. So the only data we have next week, I believe, is going to be the PPI on Friday. But I think next week the focus for us is going to be on energy, right? So we actually put on an XLE volatility play. If you've been watching XLE, it's kind of been decoupled from oil prices, and it's been very, very tight range. So I think there's going to be an explosive move coming out of XLE. And again, part of the strategy that we do is market neutral, so it doesn't matter what direction it goes. Just like with CrowdStrike, that was a monster trade for us because it moved down like $25, right? And so those are the kind of plays that really you need to take advantage of. Incidentally, I am having a class kind of discussing that strategy on Tuesday. So if you want to sign up, there's a link below to attend. That's a free class. I'm going to spend about an hour. I'm not going to go into a ton of detail, but I'll give you some ideas regarding some of the options plays that we do that I talk about in here. So if you want to take that class, go ahead and hit the link below. I've been getting about 50 participants lately. So, and I think I'm going to cut it off at around 50. So if you guys want to attend that, go ahead and click on the link. Also, if you want to come and spend 5 days with me for free, also click the link below. Yep. Yeah. Hi, Kelly. How you doing? Yeah. Awesome. Yeah. Awesome, Kelly. Great, man. I've actually been talking to a bunch of my members this week. Yeah, we had a pretty good week, right, Kelly? So, by the way, if you guys are interested in something like that, give us a shot. Flat out. I mean, I have all kinds of people you can talk to that have been with me for a while. So, anyways, okay, let's get into. Yeah, so again, if you want to attend that class next week, go ahead and do that. If you want to spend 5 days free, check out what we're doing. Also do that if you want to sign up for the newsletter, all that good stuff. Okay, if you want to contact me directly, you can private message me on Twitter or contact my support staff at transparenttradesolutions.com, and we can talk about whatever you need to talk about. Okay. All right. Now, look, all in all, so let's. I want to actually talk about one noteworthy thing that happened today in regards to the S&P and the markets in general. The VIX, right? So I've been talking about the VIX. I've been saying, back in October, remember I told you when the VIX was 35, I said it's time to buy. We got to be super aggressive. We've had a very nice rally. It hasn't, besides the NASDAQ, which is still a laggard, which I'm going to talk about in a second. Yeah, the VIX under 20 is going to be problematic for the bulls going forward, right? And if you let's start with the Nasdaq. So it kind of ties in together, right? So if you look at your chart, everybody pull up your chart of the Nasdaq futures or the QQQs, whatever, doesn't matter. If you think about it, with all of the stuff that happened this week, with with the Powell speech that had that big burst on the S&P, the Dow, but guess where the Nasdaq ended up? Did the Nasdaq? So let me ask you a question: did the Nasdaq participate wholly in that rally? What's the answer? Kind of rhetorical, right? Still languishing, still a laggard. Mega caps, Apple gone nowhere for 6 months. Amazon, blah blah blah. In fact, we're sitting right where we were about a week ago in the Nasdaq. Now, here's my point, everybody. And again, I'll ask us almost a rhetorical question: can we advance? Like everybody's looking for the Santa Claus rally and this and that, whatever, right? But let me ask you a question. Can the broad averages, I mean the broadest of all averages, like the Russell 2000 or the Nasdaq or the S&P 500, can we continue to rally as let me rephrase it. Let me reframe this. Is it possible for us to continue this rally in the S&P 500 without the participation of the mega cap tech stocks? Yes or no? What do you think? Plug in your answer in the chat there. Right? Yeah, that's and so you've got that. And even today, look at I mean, under the hood. I always talk about looking under the hood. Look at what did the semis do today, right? Look at AMD. Look at yep. So now could we turn around and get some movement on those stocks? Maybe in a couple of weeks when the Fed comes out and whatever, of course. But even today, so that's the thing. And I think it's the battle, and you saw that today with the hot jobs number, and again initially the future sold off, and they came roaring right back. So I think we probably end up bouncing back and forth, ping ponging back and forth here until the end of the year. I don't see a runaway rally anytime soon, because if you think about it, Chairman Powell already told you pretty much what, I mean, are they going to change their tune between now and, 2 weeks from now? Even if we do get a slower, like a CPI. So the CPI is the day before the Fed meeting, by the way. That's on Tuesday, a week from this coming Tuesday. So anyways, the reason I'm spending a lot of time with you on this, because and again, I'll ask you as a question, you're looking at your charts right now. Have we had any dramatic change in the NASDAQ? Clearly, no. We're sitting right where we were a week ago at this, 12,115 area in the NASDAQ, right? The S&P, now people are going to point out, well, we crossed the 200-day moving average, right, on the S&P, but we came right back to it. And if you think about it, the high 2 weeks ago in the S&P was 40.50, 75, right? We closed 21 points above that. Big whoop, right? So we actually dipped below that this morning, and we actually got a nice rally going into the close here. So it's not like we're just gangbusters going up, right? And then the Dow is still the stronger market, and that also came back. So it's going to be, I still think that the bulls have the burden of proof, if you will. Right? Does that make sense? Yeah. So the bears, I think, are still innocent until proven guilty, or the other way to phrase it is I think the bulls still have stuff to prove, right? But it's interesting. We'll see how. I think ultimately what's going to happen is I think the Powell, the next Fed meeting, is probably going to be the telltale. Because even today, you got to give the credit to the bulls because the market did come back and it's acting really resilient. So it's going to be an interesting week next week. Okay, so nothing really new on the charts that in terms of. I think if anything, can the market go higher? Can the S&P go higher? Of course it can. I think it's going to run into some issues. 4,100 I talked to you guys about last time I was here. Beyond that, it's really I think about 4,200. Maybe there's a level up there above 4,200 that looks pretty good, but there's a big pivot there where the market reversed back in September. There's another big pivot from August highs, but other than that, not any big technical levels to trade against at the moment. Would I buy a deep pullback? Absolutely. Yep. So if we get a really sharp pullback down into the mid 3,900s, absolutely, that would be better actually. So in any event. So that's pretty much it on that. And then, bonds did break out. So we've been talking about that. And that also is really interesting because that's propping up. You would think that the 10-year breaking out above 114, which is the level I've been talking about. I've been writing about that in the newsletter. We did finally break above 114. And in fact, we also were lower this morning and then we reversed. Rates still looks like they're heading lower. So the question is, if we peaked in interest rates, would that also be kind of a tailwind, if you will, to the stock market? Of course, but we'll see. The other premise that is really you could also think about when talking about the bond market and the fact that rates are coming down is the fact that the bond market now is starting to price in a recession, right? Remember, interest rates go down when we have a slowing economy. So that could be the other, you could glean that. And also this kind of change of regime where I talked about this. I actually wrote about this in a couple of weeks ago in the newsletter, where this has been the worst year for the 60-40 portfolio, meaning that, typically when you go to your broker or you go to a portfolio manager, the allocation typically is 60 stocks, 40 bonds. Why? Because bonds act as a kind of a counterweight to your stocks. So when stocks get hit, usually bonds do better and so on and so forth. Well, that was out the window. That was turned upside down this year. Everything went down, right? In fact, that was the worst. I think I mentioned this the other day. For like 100 years, this has been the worst performance for that portfolio. In other words, as you know, stocks and bonds all went down. In fact, bonds had the worst year since I think in the 1800s because of the massive tightening that's been going on. So interesting to see. Now on the trading side, again, we've been trying to get long TLT. I've been talking about this here in the channel. Just couldn't get a pullback. We were trying to get long below 100 on TLT. Couldn't get that pullback. We're sitting at 106. We're coming up to some resistance at 110 on the TLT. On the 5-year and the 10-year. Not a ton of quality above current price, which suggests that we probably go higher, maybe to about 116 on the 10-year, and then on the 30-year. Again, you got a bunch of chop coming up here on the left side of the chart. So this looks like it's going to 134, and so on and so forth. Yep. Exactly, JT. Yeah. We're talking about that as well. So I to your point, that's a great point. To your point, I think yields coming down, i.e., bond prices rallying, which we've been talking about. I think I've been telling you guys I've been really super bullish on bonds here in the last couple of weeks, actually for about a month and a half now. Um, Actually could be a signal, like you say, that we're going into a recession next year. And I do believe the odds are pretty uh, are pretty good that we go into a recession next year. In fact, if you think about what's going on in technology with all the layoffs being announced, I think technology is already in a recession. Evidence, CrowdStrike and some of these companies reporting. So, anyways, moving right along. So, at the end of the day, really going into exactly, and in fact, a lot of my members that have some sizable portfolios in cash bought 2 year and 1 year notes at 4.5, and they've actually got some nice gains because if you take a look at what's going on with the yields, they've dropped pretty good. So if you bought 4.5% paper with 6 month, 1 year maturities in the last 3 months, those yields have dropped pretty good, and so now you have a capital gains on the bond prices. So that was a pretty good deal, and especially if rates indeed have peaked, which it looks more likely that it has, meaning that we probably won't get those yields uh, anytime soon again, right? So you got to capture those yields when they're there, and essentially buying the bond prices as low as they were, right? So okay, all right, moving right along. Now, again, one of the things I've been talking to people about is uh, how strong correlations are right now. Meaning, and you want to try this right now. Put up a chart side by side, 3 charts. Put up a chart of the S&P, all in the same time frame. Let's call it, I don't know, 8 hour or a daily chart. Chart of the dollar and a chart of bonds of the 10 year. And what are you going to see? It's literally like clockwork, right? What happens even today? We had a big sell off in the futures market. What did the dollar do? Rally. What did bonds do? Drop. Then everything reversed. What happened? Stocks reversed. S&P rallied. What did the dollar do? Came up to the distribution, fell off, and what did bonds do? Rally. You guys, how many of you guys have noticed that lately? I mean, it's literally like clockwork. I mean, it's really the correlations right now. So what that means to you as a trader. So let me ask you this: if you understand that concept of correlations, and you go ahead and let's say you're bearish on the market, right? Which means if you're bearish on the market, if you think the market's going to go down, what's the dollar going to do? It's going to go up. What are currencies going to do? They're going to go down. It's the same trade. You get the idea? You ever get caught in that, right? Like it's the same. It's almost like the same trade. It's almost like if you are looking at currency markets, you better understand how this correlation works because you're essentially when you buy the yen or whatever. Yep. Does that make sense, everybody? So understanding correlations is really, really key, and that's why we practice something called triage, where we understand these correlations. If you understand how all the mechanics work, you basically have to limit your positions in one or the other because if they're that strongly correlated, it's almost like you're taking 4 times the risk if you're putting on too many positions that are highly correlated like that. Does that make sense? So that's really, and that's really in the last couple of months, that's really been and I've been talking to a lot of futures traders that really have been struggling with that, right? And so, what I talk about every morning in my sessions is this area. I mean, and we go through these charts, and it's like, I mean, all you got to do is just put those three charts up what I just mentioned, and you'll see, right? So it's really interesting. And by the way, throw in the mix the metals, right? Gold. Why has gold had that huge rally in the last 2 weeks? All you got to do is look at the dollar, right? Look at the dollar. Look at silver. Same thing, right? Speaking of which, right? So if the dollar keeps tanking, so the next level on the dollar to get through is going to be this 104. So if you got to watch the dollar to correlate against everything else, right? So let's say that stocks decide to sell off next week. You've got a strong accumulation area in the dollar at 104. Pull up your charts, DXY, Dixie, 104.40, 103.62. In fact, we bounced off that this morning and then came right back down again against another that kind of 4-hour distribution at 105. So it's going to be interesting to see if we can hold on to this. That probably assumes that stocks are going down. If we can rally the dollar from here, from this 104.4, 103 just accumulation, that means that stocks are probably going to head lower. Make sense, everybody? And then you can extrapolate that to all your currency plays as well, right? Like the yen, the more sensitive currencies are the yen and the Swissy. Look at your yen, look at the Swissy and the euro. Those are the three most sensitive currencies against the Dixie. So those are pretty good if you want to watch that. I mean, the yen was all over the place last night as well. Unfortunately, we took a stop out on that. I did short that thing last night. You know, it hit us in the middle of the night, and then it didn't work out because of what happened today. Was the dollar just was too weak. We were actually trying to short the yen, and the dollar weakness pushed the yen higher. But there are some levels coming up on the yen as well that would correlate to the Dixie accumulation, right? So finally, I'm going to run out of time here. Energies. This is the key. So as I mentioned, we did put on an XLE volatility play coming in today, and I do expect. And just a recap here on the energy space, you see nat gas getting hit again. We're having very mild weather in Europe, mild winter weather, and also I believe in the east, right? So there was some bad weather, I don't know, a couple of weeks ago in the eastern seaboard, and now we're kind of mellower and actually having relatively mild winter. So that's affecting the price of nat gas. We're still trying to get long down in the 5.5 area on nat gas. We rallied all the way up to 8 when that cold weather hit. Now we're right back down again. So that's something we're looking at. And then finally, next, and again, I already mentioned this at the beginning. Exactly, Kelly. Yep. So energy is going to be oil is going to be really, we've got OPEC on Sunday. We've got, I don't know if you guys know what December 5 is. I mentioned this the other day. December 5, we have the sanctions, the Russian oil sanctions imposed by the European Union, because they invaded Russia and all that. So that actually kicks in on Monday, and there's going to be like an energy summit in Europe or something. I don't know. So I think we're going to get a ton of volatility in oil next. Not that we don't have already. I mean, right? Remember I mentioned in the newsletter, I mentioned that level $73. I actually gave you the exact level on the newsletter a couple of weeks ago in oil. We came within 2 ticks from that, and we rallied almost $10 off that. Now we're right back down again. Looks like we're very, very choppy, very rangy, very challenging to trade. I have to tell you, that's why I'm deferring more to XLE and that type of thing. But even now, one of the things, and I'll finish up with this. You notice how many of you guys trade XLE? And you guys know what XLE is, right? That's the energy ETF, mainly, Exxon, Chevron, kind of all the big refiners and so forth. You notice oil dropped all the way down to 73 a barrel, and what's XLE done? Nothing, sitting at 90. So you would figure that XLE would come down with the commodity, right? But it hasn't. But so the next question becomes: is that going to stay permanent? In other words, so give you an example. What if oil decides to drop, all the way down to 60? Do you think XLE is going to hang around 90 if oil keeps dropping like crazy? So my point is, there has to be, that spread between the energy shares and the commodity is one of the widest I've seen in a while, and that never stays that way. So that's part of the reason why we did the XLE. I kind of thought about it afterwards, right? So there will be they're going to have to be coming together at some point, and either the XLE has to come down to match the price of oil falling, or oil has to come up to match XLE. But I believe that that spread is going to narrow, and either way, we're going to have a big move in XLE. So we're already kind of set for that, and we're giving ourselves off to January on that, by the way. So it's not going to happen. It's not a short-term play. We got some more earnings plays next week, like CrowdStrike, Best Buy, and Walmart. We did really well with those three. And we also have a volatility play still going on. We covered our calls the day after Powell, and we have another set going out to next Wednesday. Okay. So in summation, VIX under 20, NASDAQ going nowhere, energy, the play next week, I believe. Still got to get a lot of volatility. Archer Daniels, nah. No, not really. If I'm going to play commodities on an ETF, I don't. I'd rather do the actual. Have you ever, JT? Have you seen WEAT, CORN, SOAB, soybean? I'd rather play the straight ETFs on that stuff. You know what I mean? But speaking of which, grains are just nowhere. Grains are actually starting to perk up a little bit. Yep, I'm interested in wheat and corn are starting to come into some really interesting levels, which I'm going to look at next week. Right. So look at corn and wheat, particularly. I think wheat is coming into some really nice levels. That thing's been just hammered lately, but around in the low sevens is really starting to look very interesting to me in the wheat market. So I'll be looking at that next week as well for the members. Okay. Yeah, I don't know. I don't know, JT. I got other stuff. I like to just, I'm more kind of theme oriented, as you know, right? But that stock just doesn't. I don't know. It just doesn't do it for me. It just doesn't have a lot of movement. I don't know. All right. Okay, everybody. Yep. Have a great weekend, everybody. And I'll see you on Tuesday. Make sure you come in on Tuesday. We'll see what's happening. I still expect a lot of volatility and stuff, and some opportunities. Again, if you want to sign up for the class this coming Tuesday, hit the link below. I'll be posting on Twitter as well if you want to sign up for that. If you want to spend 5 days free and the newsletter, all the links are below. You want to leave me a comment, give me some thumbs up and all that. Let people know where we're at so we can grow the channel, so I can keep doing this. If not, Have a great weekend, and I'll see you on Tuesday. Okay, take care.